Job growth is one reason tonight's Market Monitor thinks the economy will pick up speed next year, and so will stocks. Mark Lucchini back with us, the Chief Investment Strategist at Janney Montgomery Scott. Always great to see you, Mark. So the job market that we saw today, improving in the last month, but still slow. Do you think it's going to pick up the pace of that improvement next year, and why?
Well, we do, Tom. I mean, the fact of the matter is we've been seeing steady, if unspectacular, job growth for the better part of 2012. Job growth averaging roughly 150,000 or so a month. But we think on the back of an uptick on several factors here that we're looking forward to improve in 2013, we could see a modicum of an uptick in job growth.
Among those other improvements, you're seeing consumers paying down debt as beneficial to the economy. But doesn't that lead to less demand, less consumer spending?
Well, we think it's freeing up their balance sheets.
Yeah.
Is what it's doing.
Which is a good thing.
It is a good thing. Ultimately, it leads to a much healthier foundation upon which consumption can be built, which is all important to economic activity.
Where are we in that deleveraging cycle, do you think? Closer to the end?
I think it's advanced. I think it's probably a 2015-16 phenomenon before we hit trend, but nonetheless well off the peak in 2006.
Businesses, meantime, are not necessarily deleveraging. They don't necessarily have to. They got a lot of cash out there, but they're not spending it. You think that they're going to let loose some of that cash, but we've heard so much uncertainty about the fiscal cliff with companies holding back. How are those two related?
Well, I think the fiscal cliff ultimately is going to be rendered into a fiscal slope. But between now and then, the uncertainty is really paralyzing CEOs of companies from big to small. And you can see it in the core capital goods orders, which have basically fallen off in the last 2 quarters, indicative of holding that business investment and hiring back, which we think will change once we have some certainty brought into that equation.
And then finally, housing, which is has shown a remarkable stability here, an uptick in several markets. But there's talk about limiting mortgage deductions with the fiscal cliff negotiation sometime next year. Couldn't that impact the recovery?
It could. I mean, I think obviously it might be relegated to more affluent households in terms of the ability to do a deduction or either in full or in part. But at the end of the day, there's still a large swath of household formation that is occurring that is going to drive, I think, prospective homeowners into the market regardless.
Let's get to the picks here. You do like housing stocks with the Home Builders ETF. What do you anticipate? They've had a nice run already.
They've been terrific investments.
Will you put new money to work?
We turned bullish about a year ago, and they've doubled or better, and yes, we would. They may be subject to profit taking, but nonetheless, we still think we're in the early innings of the housing recovery.
You also like technology. Is this a play on your business investment expectations for next year?
It is. If business wallets open up, we expect the destination for some of that money to go towards more productivity-enhancing tools, and they've been underinvesting in technology now for several years.
What about that transition from the PC to tablets and smartphones? Does that concern you at all about some traditional technology firms?
It does a little bit. I mean, Intel's intriguing and in really the sweet spot of that. The fact of the matter is, though, it's an interesting company that is trying to make itself into more of a tablet-oriented or smartphone-oriented company. In the meantime, you could pay an enormous dividend yield to wait.
Speaking of which, I know you like dividend stocks. Back last time we spoke to you, July 6th, you like ConocoPhillips and Johnson & Johnson. Both of them, in terms of just the stock price appreciation, up by single-digit percentage terms. Do you still like them? Very much so. Battleship companies, good places to be in healthcare and energy, and again, a very handsome coupon, which I think is going to matter to total return. Do you own everything that we mentioned tonight? We do. All right. Our Friday Market Monitor guest, Mark Lucchini. He's with Janney Montgomery Scott. Thanks, Mark. Thanks, Tom.